This is the Tuesday edition. Thank you for tuning in to watch us on our YouTube page, Eswatini TV. My name is Lungelele Magakula. Thank you for tuning in. Today, the Central Bank Governor, Dr. Phil Nisi, released the 2024 Annual Financial Stability Report. And in his report, he said in June 2024, the corporate sector showed signs of losses. Losses surged to 20.4 billion emalangeni. He also talked about small and medium enterprises, and he said they recorded losses for the second consecutive year, reflecting ongoing financial challenges, reaching 23.3 billion emalangeni. Economist Sanele Sibia will join us today to have a discussion on this and on how this report showcases key aspects to shape up the economy of Eswatini. He'll join us again for today's financial markets to give us an overview of how U.S. markets are performing this afternoon, and also EU markets. He'll join us today to stay with us. For now, let's go straight to our first story. And our first story, in June this year, the corporate sector showed signs of increased financial distress. Losses surged to 20.4 billion emalangeni, up from 1.3 billion emalangeni last year. This has been shared by the governor of the Central Bank of Eswatini, Dr. Phil Nisi, during a virtual presentation of this year's annual financial stability report.
In his virtual presentation, Dr. Mnisi says financial stability indicators improved, with the aggregate financial stability index rising from 0.02 to 0.50 between June 2023 and June 2024. The governor says key factors include increased bank assets relative to the gross domestic product, higher corporate credit, and improved pension assets. Continuing with his virtual presentation, Dr. Mnisi highlighted that in June this year, the corporate sector showed signs of increased financial distress. Losses surged to 20.4 billion emalangeni. This is an increase from 1.3 billion emalangeni from last year. He says the factors include an increase in operating costs and inflation, amongst others. Small and medium enterprises recorded losses for the second consecutive year, reflecting ongoing financial challenges, reaching 23.3 billion emalangeni from 12.7 billion emalangeni last year. SME interest coverage ratio worsened from negative 103.6% to
Be sure to catch Business Watch every Wednesday between 2 p.m. to 3 p.m., where we feature the latest updates on business news, market trends, and exclusive interviews with industry leaders, as well as insights on emerging small and medium enterprises in the commercial sector. Business Watch, your business leader.
Welcome back. You're still tuned into Market View. Thank you for staying with us. In a significant development today, the Central Bank of Eswatini has released its much-anticipated annual financial stability review report, offering a comprehensive review of the state of the nation's economic landscape. The report, which is closely monitored by local policymakers, investors, and economists alike, assesses key risks to financial stability trends in the banking sector and the overall resilience of the economy. Economist Sanele Sibia joins us now to share insights on how this report provides key aspects to shape Eswatini's economic future. Very good afternoon, Mr. Sibia. Thank you for tuning in. I assume you have listened to the governor's report. Does it really provide key aspects that shape up Eswatini's economic future?
Thank you, Lou. Yes, I think the governor did present his report today, highlighting that financial stability within the country. And of keynote is we've seen that the statistics show that we've increased in terms of our aggregate financial stability index from 0.02 to 0.05 or 0.5 or 0.5 thereabout. That shows that we are doing something as a kingdom, and that shows that we are actually moving forward towards a more stable economy, and financial stability is actually key to those, Lou.
Yeah, he also spoke about SMEs. We know that SMEs play a critical role in economic activities in Eswatini, and also the reported losses at 23 billion Malangeni. What is the impact of this?
So basically, when we look at the profitability of SMEs, it's more of an issue that speaks to the underlying. We are, as a country, trying to move towards growing the economy, and you cannot be seen to be growing the economy if there are those losses that are being presented and that we are seeing coming through from the SME sector and basically the corporate sector. But you cannot then say that this is a sign of weakness or a sign of a very bad economy. If you recall, coming from COVID, we're coming from a situation or from a point where we had the price of Brent crude averaging around $90 per barrel. At that point in time, we're looking into the supply chain disruptions that we saw in the past couple of years, and we're looking into those cost of living or those inflationary pressures that are coming through from the fuel shock, those movements within the Red Sea, and those supply chain logistics globally. So I think that's what the domestic economy is still trying to grapple with, and still trying to deal with those supply shocks and those costs that became then a bit heavy on the corporate sector and SME sector to absorb. But we cannot say that it's one of those historical facts, but that in level of losses at 23 billion, that's still very high, signaling that going forward we might be grappling with more volatility coming through from the SME sector. And what that means is basically, it means if the sector is not remaining profitable, then we are looking into job losses, we are looking into downstream and upstream losses, because SMEs don't exist within a vacuum. But with the improvements in the medium-term economic outlook, we do hope that eventually our SMEs should be in a position to bounce back.
All right. Another thing the central bank governor revealed is that financial stability indicators seem to have improved, with aggregate financial stability standing at rising from 0.02 to 0.50 between 2023 and 2024. What could be the key factors to this?
So what we are looking what we are looking at, Lou, is an improved medium-term outlook for the Kingdom of Eswatini. As we've seen, we've seen inflation moderating, and we've seen central banks also taking that a bit of a moderate stance from the Eurozone. We've been watching those news, and into the Asian markets, the Federal Reserve Bank in the US. So we've been looking at those risks, at those inflationary risks, and we've been following those trends in terms of what is happening in terms of the interest rates. So right now, a loosened monetary economic outlook somehow makes debt servicing a bit more palatable and more affordable within both the household sector, businesses, and governments alike. So it's those improvements that we are seeing in the overall global economy, with growth prospects also being upgraded upwards to around 3.2. So though we are seeing that monetary policy conditions such as inflation still remain above the target, but the indicators show that we are on course, and economies remain resilient. If you're looking at the growth numbers, if you're looking at the job numbers coming out from all the major economies, including our economy, it does show that we are heading for much greener for a much greener or for a much safer economic lending. And coming domestically, if you look into the performance of the banking sector, our banking sector remains relatively resilient to quite a number of shocks because of the model in itself. We are using more of a collateral-based funding model rather than a model that looks into leverages and those bubbles. So when you are looking into the configuration of the financial sector in Eswatini, the probability of any bubble occurring is relatively low, though we still have those risks with unsecured lending. But then again, if you look at those unsecured loans, you will see that it's loans that are given to people with income, relatively stable jobs. So when you're talking in terms of that financial stability in itself, there is a bit of stability and the economy is building towards shoring those up and ensuring that we are actually able to sustain and maintain that position as a country.
Still on stability, the governor says the banking sector stayed stable this year, stable and sound, and was resilient to shocks. How did this help the banks to, stay vulnerable to potential risks?
So when we're looking at the at the configuration of our financial landscape in Eswatini, you will realize that the central bank plays quite a critical role in bank supervision and also non-bank supervision. So we have quite a number of regulations in the country. For example, we know that 33% of all the financial assets that have been mobilized within the Kingdom of Eswatini must stay within the Kingdom of Eswatini. So that in a way also helps to make sure that we are not that much exposed to external shocks, but we are mostly there is that balance in terms of our investment ratios and the investment portfolios within banks. So it is one of those things that we are looking into. And then also, if we look into the situation that we are just coming back from, even if you track back and you look into earlier in the year, you'll see that there was a relatively large high rate of non-performing loans compared to the current reporting period. So right now, when we're looking into the interest rates and the easing in monetary policy, that has somehow also worked towards decreasing that non-performing loan ratio within banks. So if we also look into the capital requirements that banks must actually keep with the central bank or keep in their vaults. So it's all those issues that come into play, and also to ensure that we exercise what we call responsible lending as a country, so that we make sure that when we give out money out there, it's money that comes back and it's likely going to be repaid.
Okay. So also in his presentation, the governor spoke of the South African economic challenges and how they can impact Eswatini. How can they impact Eswatini as South African economic challenges?
So one of the key issues that we are following regarding the South African economy is that high debt to GDP ratio, which I think the report states that it's sitting around 73%. That's way in excess of the recommended debt to GDP ratio of 43% or 40% by the IMF. And if you compare South Africa with other emerging markets or emerging economies, it's still way above that. And what we are then looking into right now is in the current year, in 2023, 2020, in 2024, debt servicing within South Africa sits at around 20% of total revenue. So that means 20% of everything that the South African government collects has to go towards debt servicing. So once we are doing that, that means there are other sectors which will not be able to get those funding. It's not going to go towards other sectors. And South Africa continues to be blacklisted on that on the AFTA's task force on 17 lines. They're showing that there are those risks in terms of ensuring that money laundering doesn't occur within the Republic of South Africa. So there's still that laxity around prosecution of potential money launderers and the legal framework thereabout. So what that means, that South Africa and Eswatini are so largely linked and so largely integrated through the CMA and through quite a number of the CMA, SACO, and our trade relations. So if South Africa gets that downgrade, and if the South African currency is not looked at favorably, and if the South African financial system and the financial stability within South Africa is not looked at favorably across the globe, so we essentially inherit those through our arrangement in the CMA and the interlinkages and the continuous integration of our financial system into that of South Africa. So yes, the debt crisis in South Africa is one that's been slowly looming, and we are hoping that eventually there will be a way out of it. We're hoping that the Government of National Unity will actually present something that is quite tangible, and we're hoping that when we see the government budget coming out February next year, it should actually give us clearer direction, and it should give a clearer direction in terms of what the South African government is going to do in terms of the debt crisis. And yeah, but obviously through those channels, we will eventually one way or the other get affected because of our interlinkages with the South African economy.
All right, thank you, Mr. Spear, for that analysis of the governor's report, of the financial stability report. After the break, he comes back for today's financial market analysis. Stay tuned.
sabatandi ukuthi njengalokhu sivile sive sitikhulume
Welcome back. You're still watching Market View. Thank you for staying with us. We now want to get into today's financial markets with Sanele Spear. He comes back. Mrs. Spear, welcome back. Let's take a look at, firstly, U.S. markets. It's reported that the U.S. stock index futures were subdued today as investors have refrained from placing big bets ahead of a crucial inflation report this week that could influence the Federal Reserve at its monetary policy meeting this month.
Yes, Lou, thank you, and thank you once again. Yeah, so that's one of the key major financial news that that are making headlines. That, investors are waiting to see how inflation is going to come up, and that inflation data that comes out this week is actually going to have a bearing on how the Federal Reserve Bank plays its monetary policy direction going forward. And we know that we are heading towards a Trump presidency with a lot of tariff talks, and we do expect those tariff issues, if they are implemented, to have a bit of an impact on inflation, and that in itself is actually going to affect the Federal Reserve Bank policy on money or on the interest rate. So right now, what we are waiting to see is how the inflation figures come out and what it means for our for the Federal Reserve Bank. So what we are looking into is we are expecting a bit of a cut in the interest rate, but we are also not expecting that much of a serious. We are not expecting a major cut. So we're continuing to see those movements, but we're seeing that even though there is a downward movement, the S&P 500 still remains above the 6,000 mark, with all major indicators still remaining relatively at those all-time highs. So that means what we are seeing right now happening, Lou, is the issue of what we call a bit of caution into the markets going forward into those inflation numbers, because that's what's now going to determine how the market is going to go going forward. And also consider that in January, President Trump comes into office. So this is the last Federal Reserve Bank meeting before a Trump presidency. And we are not sure how much of the of those tariff threats they are going to take into consideration. So that's what markets are weighing in Europe, in the US, Lou. And then that's still also transcended into the European markets. When you're looking into the European markets again, there is that a bit of a caution, taking a step back in terms of looking at where the policy is going to go. So we're waiting to see what it means for overall Eurozone inflation figures coming out on the 17th, 18th, and what it means for the Bank of London. We do expect the Bank of London to stay at relatively the same, the Bank of England to stay at the same level in terms of the interest rate, and we expect the European Central Bank to also just cut down a bit. But right now, we do know that there is Berlin and there is Paris who seem to be a bit imploding, and we don't know how much that political risk is going to get infused into the market. So we are just waiting, and we are looking into those major indices. We're looking into those movements, how the central banks are going to respond. And if you remember, at the start of the year, it was more on the central banks and their monetary policy path that we were betting on to actually drive the market. So if we're seeing a bit of a let's say a stubborn inflation, then central banks have actually come out to say, we've seen in the past couple of weeks with the Federal Reserve Bank in the US coming out to say, no, there really is no rush towards easing those or on that monetary policy easing. So we are still awaiting and seeing if we are going to get that 25 basis point cut or we're going to get something lesser. But we are confident that still a cut is coming, but it's now an issue of more on the magnitude. That's what the market is actually weighing in on. Moving into Asia again, that Wall Street that Wall Street pessimism has also just found its way into the markets as well in Asia. But what we are seeing is Asia continues to be somewhat on the green. And what we've seen, interestingly, coming out of Asia is China is now trying to prosecute NVIDIA, one of the biggest tech companies in terms of antitrust laws. And that has also weighed down on markets in the US and across the Eurozone, because that seemed to be something that markets were not expectant. And we're not sure whether it's now a precursor to what the mainland is actually going to do in response to tariffs that are coming in through with the Trump presidency. And just before this, a couple of weeks ago, we saw China, putting a ban in terms of those rare earth elements, stopping those rare earth elements from being exported into the US markets. So markets are also just trying to look into those. But however, within the euros, within Asia, those Chinese government stimulus are still reverberating across the markets, and there's still that positive note. We're seeing markets closing a bit higher today. And then when we move into South Africa, what we are seeing there again is that caution coming through from the Johannesburg Stock Exchange in terms of watching the data and seeing how it is going to move, how the inflation data is going to move in the US. But what we are seeing and what is more encouraging at this point, Lou, is the fact that the numbers remain on that 87,000 mark in terms of volume. It's just the market is exercising some caution, waiting to see what those numbers are going to be. But there is a bit of an expectation of a higher inflation rate. If you look at, just a bit of a stubbornness in terms of that inflation rate coming through from the US market. So the markets are just taking a step back to caution that. But the miners have actually remained on a positive note, cushioning those losses from that tech sector across the globe, Lou. And then the domestic market, we remain relatively at the same level that we were at that 490 zone. And then coming into commodities, what we are seeing, interestingly, coming out from Syria is, that fact that we were all worried what was going to happen in terms of that transition within Syria. And we were actually expectant of quite a major shift in that price of Brent crude, because yes, Syria may not be a major exporter of oil, but there is quite a number of moving elements within what is happening within the Syria story. It could mean a resurgence of ISIS. It could mean we're seeing quite a lot of instability in terms of Iran's reach within the region, and we could see quite a lot of those instabilities in terms of the moves from Israel as well. But what we're seeing is there is a commitment that seems to be coming out in terms of forming a government that's going to actually copy a government of continuity and a government of the people. So that has somehow taken away some of those worries from the oil markets. And what we're seeing in terms of gold is because we are moving towards that inflation data, and gold is somehow increasing a bit, benefiting on that shift from those assets into gold, because we don't know, and we're seeing those 10-year yields also losing a bit of ground in the US, and that money has been transferred to gold in the present moment, so staying at the 2.26, that's 2,600 zone. And when we come into the currencies, what we're seeing across the board is a relative is a relative weakening of the Langeni across the board compared to those major currencies. That's purely because markets have just taken that step back, and the dollar has actually somehow been propped up because of those movements and the thinking around that inflation story, and same thing with the euro. Thank you.
Right. Thank you, Mrs. Ria. Thank you for this analysis for today's financial markets. And that's it for our show today. Thank you for tuning in. You were watching the Tuesday edition of Market View. Join us again tomorrow for Nedbank Business Watch. See you tomorrow.